For the first time in Shopify's short history, their share price has just surpassed $1,000 per share over the past trading week, making it temporarily Canada's most valuable publicly traded company, which seems pretty crazy. With that said, Shopify released their Q1 earnings report last Wednesday morning, where the stock grew by 6.9% in that same trading day. So in today's video, we're going to be going through all of this earnings report to see if any of this is justified. Hey, what's going on, savers and investors? I hope you're all having a great Saturday. If you're new to the channel, then welcome. My name's Griffin, and I first want to start off this video by saying the response to my latest Ryokan Q1 earnings and a balance sheet analysis video was phenomenal. You all really seem to enjoy that analysis video. For this reason, I'm going to be doing a bunch more videos in the same nature over the next week to 2 weeks, starting with Shopify for today's video, due to the fact that this was the #1 requested company for me to analyze when I made a poll on Instagram, and honestly, for good reason. This stock is just going haywire lately, so let's try to get a sense of why this is happening by digging into the numbers. Now, I had made a video a couple of months back speaking about how Shopify grew by 200% in a really short period of time, and that video was more focused towards Shopify's operations, revenue model, and expansion projects over the coming year or so. So for this reason, if you want a refresher on what Shopify's operations are and how they function as a company, I highly suggest that you check out that video in order to pre-frame what we're about to see in today's video, digging more deeply into the actual numbers. With that said, even at the time of releasing that video, when Shopify's share price was only hovering at around $400 per share, we spoke about whether or not I thought that that price was justified, and at the time I was not convinced based on current earnings, revenues, and that market cap at the time, and more than anything, that share price was being driven up by investor enthusiasm and speculation on the stock. Well, since then, regardless of if I thought the stock price was overvalued or not, the market basically just told me to stick it because it just doesn't care. And since that video being released, the share price of Shopify went up by roughly 40%, which is just nuts. This is really just my opinion, but I believe one of the main reasons why people are so bullish on Shopify right now is due to the same reason that they're bullish on all these other e-commerce and online businesses during this whole medical situation, where people are basically at home and have nothing else to do but shop online and use online-based services. Until now though, basically all of this was speculation, so these Q1 numbers are really going to give us some preliminary insight into whether or not these assumptions were true. Now, I think it goes without saying, but all of these videos take me hours and hours to make, from research, editing, filming, and basically putting the whole thing together. So if at any point in time you're enjoying this video and it's providing you value, please make sure to smash the like button. It really helps my channel out. Also, I haven't mentioned my ultimate personal finance spreadsheet in a while, but you can still pick up a copy through the link down in the description. And if you want to learn more about this spreadsheet's functionality, I'll leave a link to a video going through the whole thing right here. All right, so with all that said, let's first take a quick look at the stock quote to see what we're dealing with. And I decided to film this part at the close of the trading week on Friday to make sure that there's no real-time fluctuations while we're looking at this video. And yes, this is the Canadian stock, but the price for the American listed stock is directly proportionate to this one based on the currency conversion rate. Shopify stock has closed at $989.06 per share, down 2.68% in the day, but still up 115% since March 16 prices, which, man, for anyone who got in March at around $450 a share, what a score. And with these types of gains, obviously we're going to be speaking about them in more detail throughout the video, but consider taking the bag while it's hot. That's all I've got to say here. The market cap is just under 116 billion Canadian dollars, which, get this, is more than TD Bank, Fortis, Granite REIT, and Brookfield Renewables combined, which, by the way, are all super profitable companies that pay nice dividend yields. But I know with this type of stock, we're dealing with a completely different type of beast here. Everything else in the stock quote is pretty much non-available due to the fact that the company is not yet profitable as of the 2019 numbers on which this info is calculated. But like I said, we're going to be looking at Q1 numbers, which may bring some surprises. The way we're going to be structuring this video is first going over the highlights of the quarter detailed in the earnings report. Then we're going to be looking at the income statement, followed by the balance sheet and cash flow statement. Following that, I'm also going to be sharing my thoughts on the current stock price as it stands right now. All right, so diving into the Q1 2020 financial report, the company starts off by announcing strong financial results for the first quarter, which I sure hope so for this current stock price point. In the second paragraph, the CEO Toby speaks about the impacts that the medical situation is having on small businesses, and that Shopify is working as fast as they can to support the merchants by retooling their products to help them adopt to this new reality. Now, when reading this, I want you to keep in mind Shopify's current business model, which even though they are expanding into fulfillment networks and point of sale systems, their core business remains monthly billed e-commerce systems to small businesses and merchants that sell on their platform, where they also collect a portion of all transactions through their payment gateway. So if small businesses, or basically any online business using their platform, is hurting, Shopify would also feel that financial stress as a ripple effect. Now, obviously, having stated that they have strong financial results and a strong balance sheet, we're most likely awaiting positive numbers in this statement, but I just wanted to mention that first. Some of the initiatives the company has taken upon themselves to help alleviate their customers include extending the new shop trial period from 14 to 90 days, which actually had a direct impact of 62% on the amount of new stores created between March 13th and April 24th compared to the prior 6 weeks, which is great, but keep in mind that this does not necessarily mean that it will sustainably generate income for the company once these trial periods are over. The company has also introduced local in-store/curbside pickup initiatives to try and stimulate in-person traffic through their point of sale systems, but even with this initiative, the gross merchandise volume through point of sale declined by 71% between March 13th and April 24th, obviously due to the fact that most of these small businesses were forced to be temporarily closed, and this will therefore be more visible in Q2 earnings. But interestingly, this converted into 26% of brick and mortar merchants now using their POS system, in contrast to only 2% at the end of February. So this is a positive for the future of their POS sales. Through the company's own analysis, it's also clear to them that more unique individuals are purchasing through Shopify merchants as e-commerce is becoming increasingly popular and even somewhat required, with first-time customers to any Shopify store growing by 8% and by a staggering 45% for existing customers purchasing through another Shopify merchant. So for all of the above information, to be honest, everything was in my view somewhat to be expected, with higher levels of gross merchandise volume overall flowing through Shopify's platform and increasing demand for their services. But what stuck out to me most is this line right here, where they've increased their funding commitment to Shopify Capital, which is Shopify's lending services to their merchants, where they make interest on their lending activities. Shopify is lending out more money than ever before, with now $192 million of advances and loans outstanding as of March 31st, compared with $150 million at December 31st, 2019, and they've committed an additional $200 million above the March 31st level for the remainder of 2020. Basically, what this means is that they're lending out $242 million over the course of 2020 to their merchants to help them stay afloat, which actually also helps Shopify maintain their revenue model as well, while making interest on these loans. This to me is actually a pretty sweet situation to be in, where your customers live within your ecosystem of products and financing activities. Think of it this way: a merchant on the Shopify platform can now use their monthly subscription, use Shopify's payment gateway, their fulfillment network, and their Shopify Capital service. So Shopify is making money from every possible angle on their merchants. Now, everything we just spoke about is great and all, but we need to actually dive into the numbers for ourselves to see how Shopify is faring in this financial climate. So let's now take a look at the Q1 consolidated statement of operations. The total revenues for the first quarter of 2020 are $470 million, split between those monthly subscriptions at $187 million and then merchant solutions at $282 million, which is comprised of all other services offered to their merchants. This is actually tremendous growth, with a 47% increase over this same period of 2019. And if compared to the revenues of Q4 of 2019, so just before this quarter, the revenues have only declined by 7%, but keep in mind that Q4 is always by far Shopify's best quarter because it has Black Friday, Cyber Monday, and the Christmas season. So from a revenue perspective, Shopify is doing great as of Q1 with all of their revenue sources growing significantly. Now, the cost of revenues has actually increased quite significantly since the same quarter last year by about 52%, but keep in mind that this is to be expected for a company that's growing as quickly as Shopify with the amount of focus that they're putting on expansion and reaching new markets. If we compare this cost of revenue with Q4 of 2019, it has actually gone down by roughly 12%, meaning that their relative revenue to cost of revenue is increasing. This is translated into an almost flat variance for gross profit of the company quarter over quarter. Basically, this is showcasing firsthand the increase in e-commerce spending from the general public in response to self-isolation and buying online. With that said, Shopify is still spending tremendous capital on their operating expenses with no real signs of slowing down, as every category of their operating expenses has increased quarter over quarter, which demonstrates their aggressive expansion strategy. But this has resulted in a Q1 2020 loss from operations of $73.2 million, which is a 143% increase since Q4 of 2019. The total net loss of Shopify in this quarter is sitting around $31.4 million, continuing on their current streak of growing income, but also a growing net loss for each calendar year. So as a summary of this income statement, honestly, it's not bad considering that the company is exponentially growing their revenues and new customers through new business operations and initiatives to bring more merchants and customers onto their platform, especially maneuvering through this tough financial climate. The company was expecting to turn a profit in 2020, as we'll be speaking about shortly, but this is most likely put on the back burner considering current expenses and focus on helping their merchants. Let's now dive into Shopify's balance sheet as of Q1 2020. Alright, so Shopify's balance sheet is surprisingly quite strong for a tech company that has never even been profitable before, and I'd like to bring your attention to the fact that this is comparing Q1 of 2020 to end of Q4 of 2019. Starting with the company's assets, they currently have $3.47 billion in total assets, with $2.7 billion being current assets, mostly in cash and cash equivalents, as well as marketable securities, which are liquid assets like stocks, notes, etc. Considering that their current assets are roughly 4 times larger than their long-term assets, Shopify is in a great financial position to weather through this difficult period, and this is one of the reasons that they can financially help their merchants so much with that $250 million of loans that they're paying out to support their merchants. In terms of their current liabilities of $288.5 million, this puts Shopify's current ratio, which is a division of their total current assets by their total current liabilities, at 9.45 times, which is just stellar. Honestly, anything above 2 is great, and at 9.45, this means they could pay off their current liabilities 9.45 times in the short term with their current assets. Long-term liabilities are also extremely low at $141.5 million, meaning their total liabilities combined for Shopify as of Q1 of 2020 are sitting at $430.1 million, meaning that just with their current assets, Shopify could pay off all of their debt 6.3 times. In addition to this, even though this does not take into account Q1 of 2020 numbers, Shopify's total assets from 2018 to 2019 grew by roughly 29% year over year, which is absolutely phenomenal, and their total assets grew by roughly 55%, which is striking. For literally any company, this type of financial position is golden, and the fact that Shopify is in this position during such a rough financial climate is reassuring for shareholders. As we can see, Shopify's balance sheet is really strong, and they are well aware of this, stating that they are leveraging their merchant-first business model and strong balance sheet to adjust their 2020 plans to address the macroeconomic changes that are currently taking place in the world. And finally, let's now speak about Shopify's cash flow statement, starting with their net income for the period at a loss of $31.43 million, which is actually an increase of 30% from this same Q1 period in 2019. As we covered in the income statement, Shopify is growing their revenues year over year, but their operating expenses are also growing, creating larger net losses losses, and as of Q1 2020, the company is on track, unfortunately, to maintain that loss streak. Let's focus on the net cash provided by operating activities, which is essentially the cash that a company has been able to produce or lose after the company pays off all their operating activities. For the first quarter, they've started the year with a larger operating activity loss than any other quarter of 2019 at a loss of $84.9 million, due primarily to two elements. First off is the merchant cash advances, loans, and related receivables at a current cash loss of $46.5 million. This is essentially those increased loans that they're lending out to their merchants over the course of 2020, as we spoke about earlier, and then income tax liabilities of $90.4 million, which is basically their income tax payments for the year of 2019 that are payable right now. All I wanted to mention here is the fact that based on their lending activities, which will continue through 2020, the company might be in a position of negative operating cash flows for 2020 once again, especially since their free cash flow for Q1 is negative $107.9 million, which is significantly higher than any other recent quarter. Let's now bring our attention to the cash flows from investing activities section. The first thing that jumps out to me is the purchase of marketable securities, which Shopify really likes to do, and this is basically buying stocks and other liquid assets in the open market. In Q1, they purchased $496.2 million of marketable securities, and $913 million worth of their investments matured during this same period. In most previous quarters, the company spent more on acquiring liquid assets rather in contrast to the income produced from their maturity, creating a loss for most quarters. But in Q1 2020, most likely due to the uncertain times ahead, the company took a gain of $400 million from their investing activities, which I think is a great move and is the reason why they've been able to dramatically increase their cash position by roughly that exact amount minus the operating loss. Now, the company didn't raise much capital from financing activities in the first quarter of the year, as we can see here for common stocks issued, but it did just announce on Thursday that they would be issuing 1.85 million new Class A shares out to the public, which raises capital for the company, but also dilutes current issued shares, which is the reason most likely that the stock tumbled on Friday. What's interesting is that over the past couple of years, Shopify has never pulled a profit, but they have managed to increase their total current assets of cash and marketable securities. So how is that even possible? One of the answers to this is that the company has been diluting shares over the past couple of years since their net income is going down year over year, but their financing activities through these common stock issuances has been quite staggering, as we can see right here. They're essentially issuing shares to grow their cash position and buy more marketable securities, which is kind of odd in my opinion, considering that they're diluting current shares. But you know what? The market doesn't really seem to care once again with this stock, or they just aren't looking all that closely because prices are still skyrocketing. Let's now speak about the financial outlook of Shopify in 2020 and try to make some sense out of this share price. So in terms of a financial outlook for the company as of now, well, on February 12th of 2020, which let's remember was before the medical issue and all the catastrophes that has created, Shopify did release some financial guidance figures in regards to their revenues and operating loss projections. They were estimating roughly 2.13 to 2.16 billion in revenues and 0 to 20 million in adjusted operating losses for the calendar year, but has since suspended these statements basically because all companies are uncertain at the moment of the impact that the medical issue will still have on the global economy and potential lowered sales with more people than ever unemployed. In fact, their guidance at the time for Q1 was an adjusted operating loss of 30 to 34 million and revenues of 440 to 446 million, meaning the company actually managed to exceed their revenue projections, but since withdrawing their guidance, operating loss was pretty much thrown out the window with trying to help out their merchants through loans, which isn't necessarily a bad thing as we discussed earlier. It just means that 2020 will most likely be their most unprofitable year to date and it would have been nice to see the company finally reach some profitability. With that said though, I think that this is just Shopify being somewhat cautious with pulling their estimates to manage shareholder expectations, which is definitely smart and a fair practice for pretty much all businesses right now, don't get me wrong, but considering the earnings we just looked at and the balance sheet of the company, Shopify should be in no real trouble to maintain their operations growth and financial assistance to their merchants. In fact, revenues are up and they continue to solidify their balance sheet, which in a financial climate like now is something that all companies should strive for. I do like Shopify's focus over the years on building a strong balance sheet, which is coming in clutch right now, as well as their explosive revenue growth and expansion into new markets. It's definitely a really exciting company that has tremendous potential in the e-commerce space for the long term, but honestly, I don't really get why the stock has surged so much since March and Q1 earnings, other than the fact that investors are bullish on e-commerce and all digital companies right now. There's really no doubt that this period we're living through will forever change how customers shop, opening the gateway for more people than ever to be comfortable with shopping online. But even with a strong balance sheet and growing revenues, Shopify's revenues aren't that significant in the big picture and is on track once again for an unprofitable year based on their lending practices. Let's now look at the share price, because that alone has me questioning how any of this is possible on the current Q1 numbers that we just looked at. Due to the spike in share price, the market capitalization is currently 115.19 billion in Canadian dollars and 83.01 billion in USD, which we will be using here because all these figures in the Q1 earnings report were in USD. Due to the fact that the company has no earnings, there's no current price to earnings ratio, but what we could have done prior to Shopify pulling their guidance figures would have been to use their revenue projections to get an estimate of price to revenues. So let's just say that theoretically, in a really good scenario with everyone being at home and spending more money on their platform than ever before, which is the case for Q1, the company was able to exceed all expectations and generate 2.5 billion in revenues. Even then, when dividing the market cap by this theoretical 2.5 billion, the company's market cap right now is 33.2 times the company's potential revenues, which is really high. In comparison, this same calculation for Google is roughly 5.5. Now, in terms of price to earnings, this figure is even further overvalued, first because there are no earnings to base our calculations on, but let's just say that the company was miraculously able to crack through to some positive earnings of even 15% of that hypothetical 2.5 billion in revenues. This would put the company at $375 million in net earnings for 2020, which when comparing to their current outstanding Class A shares would put the earnings per share at 3.56, meaning that this hypothetical price to earnings ratio would be 199x. 199 price to earnings. I mean, this is crazy even for the .com boom, and remember that this 199x is on a hypothetical 15% net earnings figure. So there you have it, a full walkthrough of Shopify's Q1 earnings report, balance sheet, and cash flow statement, as well as my take on the current share price. Do I think that Shopify's share price is overvalued? The short answer is yes, based on current financial fundamentals and outlook for 2020. However, I did say the same thing when share prices were at around $400, and look at them now. This is really one of those companies that investors really seem to lose all common sense on and are basically just buying right now out of FOMO as well as emotion, which is never a good thing, but I personally cannot wait to see the future of this company as well as its share price. Who knows, this could very well be a $1,500 stock in the coming years or so. It honestly wouldn't surprise me at this point, but keep in mind that if you do invest in this company, it is much more of a speculative, high risk, high reward type of play rather than an actual investment, in my opinion. And keep in mind that investor speculation and excitement around this stock is highly priced in right now. All we need now for this stock price to drop to a more reasonable price point would be for the CEO to either go on Joe Rogan's podcast or tweet that he thinks that the share price is way too high, or why not both? So what did you think of today's analysis of Shopify's Q1 earnings report? Let me know down in the description. I'd love to know your thoughts on the company. And if you enjoyed this video, make sure to smash the like button and subscribe to the channel for more stock market investing content and company analysis videos. If you're interested in watching my recent Q1 analysis video on a RioCan REIT, then make sure to check it out right here. And on that note, thanks a lot for watching. I'll see you in the next video.